Student loans are one of those things that just stress people out constantly. Every month you see the balance, and part of you just wants it gone. You want the peace of mind, you want to be debt free, and you want to get rid of all these student loans so you never have to think about them again. But the real question is not, does this feel good to pay off? The question is, what is the smartest move long term? Because depending on your situation, aggressively paying off your loans could actually be a huge win, or it could quietly cost you tens of thousands of dollars over time. So today we're going to look at the numbers and we're going to break this down the smartest way we can. But before we jump into the video, comment down below how much student loan debt do you have, what is the interest rate, and whether or not you are aggressively paying it off or are you just making the minimum payments. I want to actually see what kind of situation some of you guys are in. And one thing I do want to preface this video by saying is that I did not have student loans, so I'm not going to sit here and pretend that I struggled with it, but I did try to do as much research as I could to give you guys the best situation and how to properly analyze all this. And that's going to be different for everybody, so make sure you know that. It really just depends person to person. So the first thing you're going to want to do is understand what type of loans you actually have. There are two main types of student loans. There are federal student loans and private student loans. So let's actually talk about the federal student loans first. There's some pretty common types of federal student loans here, starting out with direct subsidized. These are federal student loans reserved for undergraduate students with demonstrated financial need, where the U.S. Department of Education pays the interest while you are in school at least half time, which makes sense why they're called subsidized, because the government is subsidizing them. Then there is directly unsubsidized, which those are federal student loans available to both undergraduate and graduate students, where eligibility is not based on financial need. So unlike subsidized loans, the borrower, aka the person that is taking on the loan, they are responsible for paying all of the interest that accrues from the moment the loan is dispersed. And this includes during school and grace periods. There's also something called a PLUS loan. These are credit-based, and these are unsubsidized federal loans that are available to graduate students as well as parents of dependent undergraduates to cover education costs that are not met by other financial aid. And then finally, you could also have a consolidation loan, which just allows you to combine multiple federal student loans into a single loan with one monthly payment at no cost. So if you have a couple of different loans that you're trying to keep track of, you could definitely look into this option. So some of the main features when it comes to these federal student loans is the first thing is that they have fixed interest rates. So that is really good. That way your interest rate is not changing over time, and that is going to stay the same during the entire period of the loan. The next thing is that there's something called IDR, which we'll talk about a little bit later, but this stands for income-driven repayment plans. These are federal student loan repayment strategies that base monthly payments on a borrower's income and family size. So instead of looking at the loan amount, it's looking at exactly what I just said, the income and the family size. So with IDR, this often leads to lower, more manageable payments. Sometimes this could be even as low as $100. Like, it can get pretty low there with the IDR payment plan. There's also something called PSLF, which stands for Public Service Loan Forgiveness. This program forgives the remaining balance on federal direct loans for borrowers working full-time and qualifying federal, state, local, or nonprofit positions. And this is after making 120 qualifying monthly payments, so it's about 10 years of payments under an approved repayment plan, and the borrower can have their loans discharged completely tax-free. And then there's also forbearance and deferment options. So the main thing I want you to take away here is that with the federal loans, they have protections, which does change the math a lot, and we'll talk about that a little bit later, but let's actually talk about private student loans first. Now, private student loans are different because they're issued by banks or online lenders. They usually have higher interest rates, they're a lot flexible on the repayment options, and there's no federal forgiveness. And they can often have variable rates, which is pretty annoying because private loans are just like purely mathematical debt. There's a lot less strategic angles that you can take in regards to paying them off over time. So those are the main two loan types, private loans as well as federal student loans. So let's actually talk about the math behind interest so that you can at least understand it. Now, interest just equals the principal multiplied by the rate. So for example, if somebody has $30,000 of student loans at 6%, that means that they're paying $1,800 per year in interest, or $150 per month just to be in the exact same position. They're not even paying down the debt. It's $150 per month just to stand still. So let's say that your monthly payment is actually $250, then only $100 is hitting principal, because remember I said you're paying $150 just to stand still. So $250 minus $150, that gives you the $100 that is going to be reducing the principal balance of that $30,000. So that's one just brief example. Another one is if you pay extra. So for example, if somebody has $30,000 at 6%, let's pretend it is a 10-year term. So then over the course of that 10 years, the total amount they would have paid is $39,967, and the interest that they would have paid is $9,967. I mean, it makes sense. It's the total amount paid minus the initial loan amount. Therefore, that is the interest right there. And so if somebody actually adds like $200 a month extra into paying this down, you could cut years off the loan, which saves you thousands of dollars in interest. And even if you just throw an extra $100, $200, $300 a month towards your student loans, paying off the extra principal early is going to give you exponential savings. So what is actually the smartest way to approach this, or like how can you pay this off off as quickly as possible. I want to break this into like 3 different interest rate buckets because the interest rate does matter a lot. So the first bucket I want to talk about here is the low interest rate bucket. I'm talking 0 to 4% range. There are a lot of federal loans that can fall under this range because, like I said, the private loans tend to have higher interest rates. And so if we actually look at the math on things, if historically the market returns about 10% a year, inflation is, let's say, 2 to 3%, then the real cost of debt here is pretty damn low. Like if you can go get 10% in the market and your rate's only 2 or 3%, it may make a lot more sense to use your extra money towards investing into the market. So the smartest move here might be to actually invest your extra money instead, or, go out, at least get your 401k match and really try to focus more with your extra money on building assets. Now, there is some nuance that I want to talk about in a little bit, and that is that if forgiveness is possible, paying the extra amount might actually be mathematically wrong, which is a kind of hard thing to navigate, but we'll talk about that after this interest rate section. So that is the low interest rate. Now, the next one, this is more the gray area. This is the medium interest rate bucket. This is about 4 to 7%, I would say. The analysis that you're essentially doing here is a guaranteed return from paying off the loan versus your expected return from investing. So for example, if you have a 6% interest rate, that is a 6% guaranteed return by paying off that loan as quickly as possible. So you're comparing that guaranteed 6% compared to an 8% return that you're expecting from the market, but that does come with volatility. For example, the stock market's not going to average 8%, 8%, 8% every year. It looks more like negative 20% and then plus 15, plus 20, plus 25, and then it drops another 15, 20%. So like it's extremely volatile and can change year in and year out. It's not like it's just 8% every single year or 10% every single year. So this is where your risk tolerance really matters. Now, I'm not a financial advisor. This is not financial advice, but what I would personally do here is I would probably split my extra money 50-50. So let's say my interest rate on my student loans was 6%, and let's say I had $500 extra a month and I didn't know what to do with it, assuming I already have an emergency fund, then I would probably take $250 and work towards paying down the loan quicker and then invest the other $250. But again, this really just depends person to person and what your risk tolerance is as well. And another thing that's kind of difficult when talking about this is, yeah, the interest rate matters, but so does the loan balance. Like there's a huge difference between having $10, $15, $20,000 in student loans compared to having $70, $80, $100,000. So there is a lot of nuance to this whole student loan situation, but again, it just comes down to what each person prefers themselves. So that's the medium interest bucket. Now the high interest bucket, I'm talking 7% or higher on the interest rate. In my opinion, this is just aggressive payoff territory. You got to be paying this down as quickly as possible. And the reason why is because it is a guaranteed 8% plus, which is extremely hard to beat. Like you are guaranteed, let's say your interest rate is 9%, that is a guaranteed 9% interest you're paying every year. And you want to just pay that down as soon as possible. You're not going to go beat that in the market. And even if you do for a couple of years, who knows if you're going to do that long term. Like I said, it's guaranteed compared to when we look at the market, it is what we expect the market to return, but it is extremely volatile. And this is a tax adjusted risk-free return from paying off this debt, which is a really strong argument as to why you need to pay off that high interest. And some of the private loans can actually fall in this range, the 7, 8, 10% range, right around there. So those are the 3 buckets. Now let's actually talk about federal forgiveness and the math behind it. Because like I talked about before, there's something called IDR, which that's where the payments are based on your income. Your balance may be forgiven after 20 to 25 years, and the forgiven balance might actually be taxable, but that really just depends on how our tax structure and all the laws look 20 to 25 years from now, which is a really hard thing to predict. So there's the IDR side of things, as well as the PSLF, the public service loan forgiveness. This is where you have 10 years of qualifying payments and the forgiveness is tax-free. So let's say that someone owes $80,000 let's say that somebody owes $80,000 and on IDR, they're paying $300 a month. Well, then after 20 years, they would have paid $72,000. But if the required IDR payment is low relative to the loan size, the payment might not even cover all of the interest that's accruing over time. So over time, the balance might shrink slowly, it might stay similar, or it might even grow. And let's say after 20 years, because the payments were income-based and relatively low, there's still $50,000 remaining. Then under the IDRS forgiveness rule, the remaining $50,000 is forgiven. So the borrower paid $72,000 total, and they avoid paying that remaining $50,000, which is pretty awesome. So the thing that's tough with this whole scenario is that if you qualify for forgiveness, aggressive payoff might actually be mathematically wrong, because then you would have less money forgiven. But again, you're taking a bet on where our legal system is going to be in regards to all this stuff 20 plus years from now, which in my opinion is very hard to predict. And the forgiveness after 20 to 25 years might be taxable, and that does depend on future laws. So when it comes to IDR, this typically works best for people with lower income relative to their loan size or people with really large balances. In my opinion, it doesn't make sense to have IDR if you're a pretty high earner, like if you're making $100, $150, $200,000 plus a year, if you have a small loan balance, or if you have a very short repayment timeline. So the main reason you're probably watching this video is you're asking yourself, yourself, should I pay off my loan early? Should I save? Should I invest? Like, how do I do this? So let's actually just look at the math here. If you were to owe, let's say $40,000 at 5% interest, and let's say that you have an extra $500 a month that you can do whatever you want with it, then if you pay off that loan early, it is essentially a guaranteed 5% return on that money because every extra dollar avoids future interest. And over time, that could save you several $1,000s and eliminate the debt years even sooner. But if instead you invest that $500 per month and you earn an average 8% return, the compounded growth over 10 years could significantly outpace the interest savings from early payoff. And the key difference here is certainty. Paying down the loan gives you a guaranteed return equal to the loan rate, like what I've talked about this entire video, while investing does offer a higher expected return, but with volatility and risk. So the smart choice depends on whether you value guaranteed savings or are you more comfortable taking market risk for potentially greater long-term growth. And one other thing I do want to at least point out here is even if you ignore all of the math, right? Let's just talk about the fact that there is a huge psychological benefit for paying off your loan early, even if your interest rate is, let's say, 3 or 4%, because then you're never going to have to think about it again. Seeing that number just completely go away, I understand that financially it might not be the most optimal thing, but there is a psychological aspect and there's a ton of stress relief when it comes to getting rid of all your debt. And so if somebody does decide to go that route, I completely understand it. Again, it does depend on who you are and what your risk tolerance is and basically what trade-offs you value the most. And so what's actually a good order of operations here, I feel like one of the main things you can do is, start out with building an emergency fund, get your 401k match, and then just pay off any high interest debt. And I've even talked about this in prior videos. After you pay off any high interest debt and max out any tax advantage investing, I'm talking about your Roth IRAs, your HSAs. And then from there, I would decide between moderate rate loans versus investing. Again, if it's a low rate loan, I would maybe just hit that monthly payment every month, but that's just what I would do. And that's my risk tolerance. So that is the order in which I would do things here. So the smartest and the quickest way to paying off your loans, it's not the emotional one. It is knowing your interest rate, it is knowing your loan type, and it is knowing all of your different trade-offs. And me personally, if I had a lot of student loan debt, I do not think I would take the route of, hoping that it gets forgiven way later on from now, like 10, 15, 20 years. That just seems like a really risky bet in my opinion. I'd rather just get rid of the debt if I could. But again, this does depend on the interest rate. There's an entire video I could talk about on whether college is even worth it or not these days, and I probably will sometime in the near future. But student loans definitely put people into a very horrible position. I believe there's even certain types of student loans that if you were to file for bankruptcy, they're still not forgiven. I'm assuming that's the private student loans. Don't quote me on that. So if you can get rid of these student loans and not have to deal with debt, I completely understand why you would prioritize that over saving or investing. But again, make sure you have that emergency fund just in case if stuff comes up along the way. So that is it for me. That is my take on how to pay off your student loans the smartest way possible. This is a plan that I do believe actually works, and I do believe that you could pay it off pretty quickly here. So I hope you guys enjoyed the video. If you did, drop a like down below, hit that subscribe button. I'll see you in the next one. Peace.